The house always wins. Why trade like a casino? Think about your last trip to a casino. What makes it so profitable? It's not just luck. Casinos understand risk and probability better than anyone. They know the odds are in their favor, even if they lose on some individual bets. Trading successfully is remarkably similar. It's not about winning every trade. Instead, it's about having a system where the odds are in your favor over the long run. This means managing risk like a casino, taking calculated bets, and focusing on consistent gains, not just chasing big wins. Playing the odds, understanding risk and probability in trading. Casinos carefully calculate the odds for every game. They set rules and bet limits to ensure profitability. In trading, your rules are your trading strategy, risk management plan, and emotional discipline. Before entering any trade, you need to know your potential risk and reward. What's the maximum you're willing to lose? What's the realistic profit potential? Just like a casino wouldn't offer a game with a negative house edge, you should only take trades where the potential reward justifies the risk. Nifty examples: HDFC Bank and Reliance Industries in action. These two companies are not just any stocks. They are among the most influential in the Indian market. Let's bring this concept to life with real-time examples from the Nifty 50, HDFC Bank and Reliance Industries. These stocks are often the bellwethers of market trends, reflecting broader economic sentiments. These two heavyweights often guide market sentiment. When they move, the market listens. Their performance can set the tone for the entire trading day. Imagine HDFC Bank is trading at 1500 rupees. This price point is crucial as it often acts as a psychological barrier for traders. You believe it will rise to 1550 based on technical analysis, which we'll explore soon. Technical analysis involves studying past market data to predict future price movements. However, you also set a stop loss at 1480 to limit potential losses. This is a safety net to protect your investment from unexpected downturns. This means you're willing to risk 20 rupees per share for a potential gain of 50. Calculating the risk-reward ratio helps in making informed trading decisions. This risk-reward ratio of 1 to 2.5 is favorable and aligns with smart risk management principles. Effective risk management is key to long-term success in trading. Similarly, you might find a trading opportunity in Reliance Industries based on its price movements and news about a new product launch. News events can significantly impact stock prices, creating opportunities for traders. You buy the stock at 2400 rupees, set a stop loss at 2370, and aim for a target of 2460. Setting clear targets helps in maintaining discipline in trading. Again, the risk-reward ratio is attractive, and you've defined your exit points clearly. Knowing when to exit a trade is just as important as knowing when to enter. By understanding and applying these principles, you can navigate the complexities of the stock market more effectively. Both HDFC Bank and Reliance Industries offer valuable lessons in strategic trading. Remember, successful trading is not just about making profits, but also about managing risks and making informed decisions. With practice and the right strategies, you can achieve your trading goals. Technical tools of the trade. Moving averages and RSI explained. These tools are essential for traders who want to make informed decisions in the financial markets. Casinos use sophisticated surveillance systems to track every bet and player behavior. This ensures that they can monitor and analyze patterns to maintain fairness and security. Traders have their own tools, technical indicators. These indicators help them analyze market trends and make predictions about future price movements. Two popular ones are moving averages and the relative strength index, or RSI. These indicators are widely used because of their effectiveness in identifying market trends and potential reversals. Moving averages smooth out price fluctuations, revealing trends. By averaging the prices over a specific period, they help traders see the overall direction of the market. For example, a 50-day moving average shows the average price over the past 50 trading days. This can be particularly useful for identifying long-term trends. If the current price is above this average, it suggests upward momentum. This indicates that the market is likely to continue moving upwards, which can be a signal to buy. RSI measures the strength of price changes. It helps traders understand whether a stock is overbought or oversold by comparing the magnitude of recent gains to recent losses. An RSI above 70 often indicates an overbought condition, while below 30 suggests oversold. These levels can signal potential reversals, helping traders make more informed decisions. These signals can help you time your entries and exits more effectively. By using moving averages and RSI together, traders can develop strategies that maximize their chances of success in the market. Don't put all your eggs in one basket. The power of diversification. Casinos don't rely on a single game for their profits. They offer a variety of options to attract different players and spread their risk. Similarly, diversification is crucial in trading. Don't put all your capital into a single stock or sector. Diversifying across different asset classes like stocks, bonds, and commodities can reduce your overall portfolio risk. Within stocks, consider diversifying across sectors and market capitalizations. Beyond the charts. Unveiling value with fundamental analysis. While casinos focus on probabilities, successful traders also understand the underlying game. In trading, that's fundamental analysis. Fundamental analysis involves evaluating a company's financial health, management quality, competitive landscape, and industry outlook. Key metrics include earnings per share, price to earnings ratio, debt to equity ratio, and return on equity. For example, before investing in HDFC Bank, you'd analyze its loan book, net interest margins, and asset quality. For Reliance Industries, you'd assess its refining margins, petrochemical demand, and telecom performance. The winning hand. Combining technical and fundamental analysis. Imagine you're playing poker. It's not just about the cards you hold, it's about reading the entire table. Knowing the rules and probabilities is essential, but you also need to observe your opponents, their betting patterns, and any tells they might have. This holistic approach increases your chances of winning. Similarly, combining technical and fundamental analysis gives you a comprehensive trading edge. Technical analysis involves studying price movements, chart patterns, and market trends to identify potential trading opportunities. Technical analysis helps you identify trading opportunities based on price movements and market sentiment. It's like understanding the probabilities and patterns in poker. Fundamental analysis, on the other hand, validates those opportunities by assessing the underlying business strength and future prospects. It's akin to observing your opponents and understanding their strategies. For instance, you might find a bullish technical setup in HDFC Bank based on a golden cross pattern, where a short-term moving average crosses above a long-term one. This indicates a potential upward trend. Confirming this with strong earnings growth and positive industry outlook from your fundamental research increases your confidence in the trade. By combining both analyses, you not only identify potential opportunities but also validate them, making your trading decisions more robust and informed. This dual approach helps you navigate the complexities of the market, much like a seasoned poker player who uses both skill and intuition to win. It's about making informed decisions that are backed by data and insights. In the end, combining technical and fundamental analysis is like having the best of both worlds. It equips you with the tools to not only spot opportunities but also to understand the broader context, ensuring you make well-rounded and confident trading decisions. Trade smart, trade consistently. Your path to market success. Trading like a casino isn't about getting lucky overnight. It's about approaching the market with a calculated and disciplined approach. By understanding risk management, utilizing technical indicators like moving averages and RSI, diversifying your portfolio, and combining it all with insightful fundamental analysis, you can tilt the odds in your favor. Remember, consistency is key. Just like a casino, focus on making smart trades over time and you'll be well on your way to building long-term wealth in the stock market.